Hi, my name is Jason Swartz, and I'm a portfolio manager at the Old Mutual Investment Group. This year's budget delivered both positive and negative implications for investors, and I'd like to quickly tell you how we are thinking about positioning to take advantage of market movements. Overall, I think it was a good budget, but we remain concerned that fiscal targets are too optimistic. In terms of asset classes, 2024 is the year where risk appetite for South African bonds could really improve as we head into the global cutting cycle. But this asset class will face significant event risk around both the timing and pace of monetary policy, national elections happening in May, but importantly, how the outcome of this budget will balance potential spending pressures versus protecting revenue. What was clear from the budget was that National Treasury continues to be very agile around their deficit funding strategy and their ability to use different financing sources where fiscal slippage doesn't necessarily translate to higher issuance. The wildcard for us was definitely government's announcement to use the gold and foreign exchange contingency reserve account to fund the deficit. This was great for South African bonds and will offer some short-term tailwinds to offset expenditure pressures. We think the budget is net positive for South African equities. While some parts of the SA market aren't that sensitive to GDP growth, we think the more SA-facing and cyclical parts of SA equities should benefit at the margin from improvements on spending on social grants, spending to alleviate energy constraints, and particularly improved developments around Transnet. Now, Transnet has obviously become quite a huge policy headache for the government and a headwind to growth in exports, where the loss in volumes has cost South Africa more than 1% of GDP. So to the extent where we can see some improvement, this should be really good for South African equity. And it's good to see that National Treasury is stepping in with a conditional guarantee facility of 47 billion rand to support its core activities. Similar to SA bonds, the rand is vulnerable to poor domestic news flow, including political uncertainty, high fiscal risks, and inflation risks. The rand has been one of the weakest currencies in 2023, but given its deteriorating fundamentals, it's not actually as cheap as one would think. Having said that, I think the budget will be seen as positive for the currency, particularly given concerns around fiscal slippage, which was already discounted into the currency. Our view is that the rand could show some modest gains as that risk premium compresses into better risk appetite and a global cutting cycle this year, but will likely continue to be under pressure as long as progress on growth-enhancing reforms is slow. Bringing this all together, we think the budget hasn't significantly changed our view that local assets should have scope to outperform on a cyclical basis this year. But it's really the secular story around low potential growth and long-term fiscal risks that will continue to weigh on local assets and limit their ability to unlock value.